Today's mini lesson is focusing on credit. There are a lot of different forms that credit can take on, including credit cards and loans. And so, this mini lesson is going to really focus on the benefits and possible consequences of getting involved with borrowing credit. The learning target for this lesson states I can use credit to evaluate the benefits, costs, and potential impacts of using credit to purchase goods or services. Later on in this lesson, you're going to have the opportunity to compare and contrast different credit card companies and consider which one might be the best fit for you. So, first of all, I want to provide you with a basic definition in terms of economics, in terms of the word credit. By definition, credit is the financial arrangement that allows individuals or businesses to borrow money with promises of paying back with interest. In other words, an individual can use a credit card or use a loan in order to borrow money to buy a specific good or service during a specific time period. Sometimes those are short term investments, sometimes they're long term investments. However, businesses can also be in the same boat where maybe they want to buy new machinery or add on a new location of their business. And so they are also borrowing money from a bank or other institution. So, first of all, I want to talk a little bit about the benefits of credit. So, by borrowing on credit, it allows individuals to have immediate access to a good or service. In other words, someone is immediately able to buy a good or service that they may not have the current cash or means to purchase. It also allows them to leverage future income. In other words, they are able to promise that they are going to pay back money from their future paychecks in order to pay off the debt. Sometimes this can be on a schedule where they're paying a regular price monthly or annually, and sometimes it can be just they pay it back after they get the funds from their next paycheck. It also allows individuals to pay emergency expenses. So, for example, this could be medical bills. So, if you have a copay on your insurance that you cannot currently pay for, credit cards allow you to delay that payment for a set amount of time. Or, for example, if your car breaks down and you don't have the money to fix it, but you need a car to get to work to be able to make money to fix it, then it can delay those payments as well. By having a credit card, it allows individuals to build a credit history. By having a credit history, it allows you to obtain loans, mortgages, and future interest rates. So, in other words, by using a credit card, improving to the credit card company that you are paying back your bills on a regular schedule and that you are basically following through on the credit line, it is allowing others to trust you in the future. So, for example, if you go to a bank and you want to take out a mortgage for a house, then they may be more likely to allow you to loan money from that bank because they have seen that you have paid off your debt in the past. Similarly, if you go to rent an apartment, they check your credit line because they are not going to want someone that has a lot of debt, because if they have a lot of debt, chances are they're not going to pay their bills. And if they don't pay their bills, then they would be better off renting that location to someone else. So, as much as there are benefits, there are also costs of credits, especially with things like credit cards. So, credit cards are great as long as you are not overspending on them and as long as you're paying them off monthly. However, if you're not doing those things, then the interest charges on the borrowed amount can be fairly substantial. So basically, what happens when you get a credit card bill, you have two fees on there. The one is the amount of all the money that you spent on that credit card for the month. Generally, credit cards have a limit, so you can only spend so much. But as long as you spend under that limit, it will identify how much you owe them based off of the amount of money you spent since your last credit card bill. However, the second cost indicates the minimum amount you have to pay. So let's say you had a medical expense where you had to pay off a hospital bill. And when you get your credit card bill, you cannot pay the full amount. Well, they'll give you the minimum amount that you need to pay for that credit card bill. However, if you do not pay the full amount that you borrowed and instead are choosing just to pay the minimum amount, then you are going to have to pay back the amount that you're not paying on that specific credit card bill with interest. And that interest can get very substantial over time. If you only do it here and there in cases of extreme emergencies, it's not a huge deal. But when you start incurring these fees over and over and over again, you're paying a substantially increased interest on the amount that you're paying with your credit card. And you don't want to get in that business at all. There can also be fees, so you will be able to look at different credit cards and kind of compare them. Some have annual fees where you have to pay a fee once a year, sometimes in January, sometimes in the month that you opened the credit card, to basically keep that credit card open. The late payments, so if you don't pay your bill on time, then sometimes it incurs interest, sometimes it's just a standard late fee. Sometimes when you transfer balance from one credit card to another, that can also add an additional fee. And because of the structure of credit cards and them allowing you to buy things without having the direct means or demonstrating you have the direct means for it, it can cause a potential debt accumulation. So people that have a whole bunch of credit cards and are maxing out those credit cards every month and are just paying the minimum amounts on them can incur substantial debt. So now we're going to look at the impact of credit not only on the consumer, but also on the economy in general. So by having credit cards and allowing people to purchase things on credit, it allows for further consumer spending because people are able to spend more money in the economy than what they directly have at a given time. And by doing so, it promotes economic growth. So, because people have more money available to spend at any given time, they're able to buy more goods and services within the economy, and consequently, the businesses thrive better. There are also financial responsibilities and disciplines of individuals that really come up with credit. So, by having a credit card or borrowing on credit in other ways, it requires people to manage their debt. And so, making sure that they're paying off their credit cards and not accumulating these huge bills. It requires them to have timely payments because those late fees can be very expensive, and it requires them to stay within their means. So even though you have an available credit line, you need to make sure that you're staying within your means and that you are going to be earning back the amount that you're purchasing on your credit card within a set amount of time. Most like best case scenario, you want to be able to pay that off by the time you get that bill. So the kind of consequence of that can be is there can be a risk of overdependence for everyday expenses. So if someone is constantly relying on the credit card and constantly only paying that minimal fee, it can cause this overdependence where they require these credit cards to be able to buy those immediate needs, food, shelter, clothing, whatever the case may be. So, within this lesson, you're going to have the opportunity to compare different credit cards, and along the way, you're going to be making some choices as to which one you think is the best and why.